Well, it is the start of a new month and a new quarter, and we have a lot of things going on. But this show is not here to predict the next outcome. It is to prepare you for what can lie ahead. So we're going to talk about the bullish cases and the bearish cases as we usually do, because on the Stock Market Brief Show, where we navigate these financial markets through the lens of technical and intermarket analysis, it's our goal to preserve and protect the capital that we have and obviously grow it through time. We're going to get right into today's session. There is news out there of Iran's action against Israel. Now, they did mention that it was concluded unless they invite further retaliation. And well, the Israel Defense Forces said there will be consequences. We will respond wherever, whenever, however we choose. So I'm no geopolitical expert. I'm not going to pretend to be like the many that are out there out on FinTwit. But what I can go over is what the markets are doing in response to this news and to these attacks. Crude oil shot up quite significantly on the trading session. It was up 1.53% on the trading session, and we saw a big pop. Now, this is important. Why is it important? Let me show you with data. If I look at a relative strength line right here between XLE and SPY, so this is our RS line, that means when the line goes up, it means energy outperforms S&P 500. Now, I'm using XLE as the proxy. That's the S&P 500 spider, okay? Now, the reason why I'm using XLE versus WTIC is because XLE is also very correlated to oil. Now, what you'll see is when it goes up, meaning that energy outperforms the S&P 500, what happened to the S&P 500 below us? Well, you can see this shot up, and we went through a correction there in 2022. Bear market in 2022, I should say, not a correction. And then in August to about November of 2023, we saw energy take off again. And well, what happened? Well, the S&P 500 did go through a correction. And then even in the near term, in the first few parts of the month, right, in the first few months of the year, energy was the top performer. And typically when energy is the top performer, it can potentially mark tops in the market. Now, that was the start of the year. What happened to the S&P 500? Well, we saw a little quick blip to the downside. And then all of a sudden, guess what? The S&P 500 outperformed energy by a long shot, and we started to see the market rally back. So why is this important? Well, we're seeing energy take off. We're seeing oil take off. Is this telling us that, hey, this relative strength line, we might start seeing strength? And if that's the case, is the S&P 500 going to take a little bit of a breather? I think we got to be prepared for that and understand that that is what happens and what has happened in the past when you have that outperformance. Now, another thing to point out is the relationship between the 10-year yield and oil. And oil typically follows the 10-year yield. The 10-year yield typically follows in oil's foot tracks. So what do I mean? Over here in April of this year, oil started to fall. What happened shortly thereafter? Well, the 10-year yield started to fall, right? The 10-year yield, by the way, is the candlesticks. The black line there is oil. Okay, then you see right here, we started to find a little bit of a bottom here in oil. We started to move up, and then 10-year yield popped up there too, and we continue to kind of track down. And then oil recently in September started to see a pop. The 10-year yield kind of kept on dropping, and then boom, we saw a little bit of a pop. So if oil is going to start rising and then the yield starts rising too as well, well, perhaps this is going to go back to the whole sparking of the inflation fears. And now why this is all happening, where do people fly to safety? Well, we did see a big pop in the dollar. And as we know, a flight to safety into the dollar has had typically a negative correlation to various commodities and assets such as the S&P 500. For example, when the dollar started dropping here in May, you can see, boom, May, boom, we put in a lower high, and then we started falling. What was the S&P 500 doing? Well, take a look. This big pop in the dollar into middle of April to May, the S&P 500 fell. Boom. Okay, then it started falling, and then, well, what happened to the S&P 500? Well, we started moving up all the way and through to where we are today, and we're starting to see some strength back in the dollar and this S&P 500 to get hit. So is the dollar actually going to find its legs here, or is it just a little fake out? It's going to come back down, the S&P 500 is going to carry on its way? If that is the case, I know the levels to watch for, the trends, and everything that we need to talk about in a little bit, so we'll cover that. Now, that's not the only thing that's been going on that's been sparking some concerns and giving us warning signs on today's midday update. If you're not on my Patreon, I have a free version and a paid version. Every once in a while on my free version, I'll give out a midday market update. So go sign up for free. And if you want to come in, it's a whole $9 a month, or you can even get a deeper discount by paying for the entire year. Come check it out. I give a lot of stuff. It's on the alert service, but ask somebody in the comments. They'll let you know what it's like. Okay. Gold has been cranking higher. We're just very shortly separated from its all-time highs. We had a nice base breakout. We consolidated very tightly here. We had some follow-through. It's in a bullish trend. So this reach to this global commodity that's known to be more of a flight to safety has been seeing some very, very, very significant strength. That's not all, though. So while the whole geopolitical stuff has been sparking off, Lockheed Martin, right? Defense names started flying too today, right? This was up 3.64%. And this was, this was showing us things before this. We were seeing it break out of these very tight bases. Boom. And we saw just some explosion in these various defense names. RTX today up 2.67%. And this one's at new highs for the year, right? Lockheed Martin's new highs for the year could be all-time highs. I'm not 100% positive. I didn't look back that far. And then Northrop Grumman, I'm not pronouncing that right. NOC, also very tight consolidation, breaking to a new high for the year to date as well. Now, it's just not defensive names. It's not just gold. It's also utilities. And utilities have been, to an extent, parabolic. All right. These things are new highs on the year once again. And these things have been the top performer year to date, right? So we're up 31% on the year, which is double the performance of tech. Double the performance of technology names. Utilities. Let me repeat that. Utilities is outperforming tech. Double. Absolutely bonkers. They're almost outperforming my portfolio on the year. Crazy. And I had to be super focused all the time. Now, the reason why I bring that up too is because when you start seeing relative strength in utilities, financial, real estate, which we've been seeing these last 3 months, and utilities for a while now, it does sometimes mark and can have the potential to mark the top of an economic cycle where you could potentially obviously go into potential recession. Now, that's not always going to be the case. And that's what's important about this episode, because if it's not the case, we need to prepare for what could potentially come shortly after, which means that we'd be rotating right back to find out some other strength if the market wants to obviously continue this rally. And we'll go over that. More importantly, a very important chart, this one that we put in the thumbnail. Okay, let's continue on. BP SPX chart, right? It got frothy, man. So we're seeing a pullback into October. Big deal. The RSI, it's burnt to a crisp. It's when we start crossing through 70. That can bring on some more weakness that we've seen in the S&P 500. But yeah, it's got to take a little breather at some point, people. Nicey McClellan oscillator over here has had this divergence as we've been putting in higher lows. And to see this come off at some point here too would make sense as well. We did just cross under zero. So we had this negative divergence building. We're seeing a little bit of weakness. We'll continue to monitor that. And then even the Dow Jones Industrial Average BP chart, this one has a negative divergence here, and it's frothy. It's at a very high reading, just like the utilities BP chart, right? That we pointed out in a prior video. To see the market come off a little bit, reset, consolidate, especially in a month that's known for volatility, does make sense. And that's kind of where the opportunity might lie. Not necessarily, hey, I'm going to short the market, but we'll talk about where the opportunity could potentially lie. But I first want to talk about volatility. Volatility also, back month versus front month, reached a pretty extensive reading at 1.2, which means it's 20% higher than, back month is 20% higher than front month. And when you get to these readings, it can mean that the market stalls out a bit, consolidates like it did here. Over here, it stalled out and sold off a little bit. Over here, it stalled off, and now it's kind of consolidating, pulled back a little bit today. And then when you get back into these areas down here, this is where you can find potential bottoms. Very similar to here, we saw this crazy rip to the downside, mark the bottom there in August after all that spicy volatility that we got. Now, with that said, if you take a look at the money vol, implied vol, and we take a look out at October 4th, you see all of a sudden a little bit of a spike up. What is that? That is the non-farm payroll reports. So volatility is here, and we'll get more into that as to what to pay attention to in a moment. Now, this is important because as we're seeing that vol spike, the weekly expected move for the S&P 500 was $99 this week, and the prior week was $75, right? That's a pretty big difference. And then the week prior to that was 100. Okay, so last week volatility fell off a cliff, and then this week, before we even came into this week, right, on Friday or of the close of business on last Friday, we said this is what the volatility was, and it said here's your upper level, here's your lower level, and now I pulled volatility again, and it's $90 still. So yeah, $10 came off, and we still are pretty much wide open for the trading week. A little bit of a concern for me is looking at this chart. This is the SPY and the Qs. Okay, on the daily time frame, and what I'm pointing out here is the importance for Qs to start to find some strength at some point. Why? Because the Qs has led the S&P 500 to the downside. Now, we've already talked about energy, if that outperforms, how that could be bad. But also, you got to stack on factors like this. The SPY, when it reaches up to new highs, and when the Qs didn't, it's marked off actually from the last few years here. I could probably go back further. This one's kind of more flat. I don't know if you want to even consider this one really, but it's clearly the S&P 500 ripped higher and the Qs didn't. But you can see that the Qs' lack of performance did bring the market obviously down, both through this bear market here in 2022, this correction here in 2023, and this little spike of volatility here in 2024. And the reason why I'm pointing it out now is because look at the Qs. We have not had a new all-time high, so they need to adjust quick as the SPY keeps pressing itself higher. Now, as I've stated, October is the month that you typically get more volatility, especially in an election year. And even in a non-election year, you get it towards a spike of volatility towards the end of the month. Well, we've already seen a little bit of a spike of volatility. Doesn't mean that we have to go down this amount or whatever the case is. But the opportunity, in my opinion, is if we do get this volatility and things come off, to whatever extent that may be, the back part of this month and then into November and December are typically bullish. And the only way that the markets are going to be bullish is if these growth names actually perform. So the reason why I'm bringing this up, both the bearish case of what we just pointed out, but then the bullish case is if we start to rotate back into tech and we see some volatility or continued volatility, I think you should be prepared to take advantage if we're going to get some moves. And I'll tell you how I'm going to go about that. First and foremost, we can take a look at the 5-day moving average, the direction of it. I talk about it every episode because it's just that important, and it determines if I'm going to have more exposure into the market or I'm going to have less. And when we get below a 5-day moving average and it starts turning red here and it starts declining, then I let the market do its thing. I don't really add new positions unless if the position is like A+, and even if so, it's a smaller position. So now I play the waiting game. I just wait it out. I just say, okay, if once we start to recover, once this starts to turn green again, and once price recovers, I'll go from there. But then another case here is the flip line. Now, the next day, hours, whatever, is going to be very important because we're right at this flip line. And the flip line, you can call it like exact number. It's at 5,700-ish right now, okay? But it's kind of a zone. Give it 10, 15 points and a close below there. But we're right at the gamma flip line. And when we're below it, it forces dealers to sell into the selling, all right? And then buy into the buying, which increases volatility, that we pointed out many times. If we hold above it and we're back above, and we get back above a rising 5-day moving average, volatility will typically decrease, and you'll have dealers look to buy the dip and sell the rip. Right? Buying the dip and selling the rip decreases volatility. Okay, so that is what I want to wait for. I want to wait now to see if the market's going to perform. But while the market is going through this turbulence and the news and the narratives and whatever the case may be, I like to look and see what's going on in the chart. So if I'm just looking at the Qs on the daily time frame, first and foremost, we broke out of this consolidation pattern. We ripped up higher. You can see these small little tiny candles during all that tight volatility, and now all of a sudden we're getting wider range candles. So volatility's coming back. Had a little bit of a distribution day today, but we managed to hold this day's anchored volume weighted average price. So if we pull back, I mean, it still would be technically a higher low, and I would be looking once again to reclaim this breakout level over here because we did put in a higher high, right? So we have higher lows, we have this higher high. These are positive signs. So if we pull back even here and start moving up. I'd be looking for that 5-day moving average for price to recoup, for it to flatten out, and to start to turn back up. And that would just be another higher low to potentially follow this trend. Okay, it wouldn't be until we start crossing really down here, then I'd be like, oh, okay, the structure is breaking a little bit, and we got to be a little bit more cautious from that point. So it's going to be important to watch this. And you might not look at the cues. You might look at XLK. And take a look at XLK. We have a low. We have a higher low, right? This area of supply is clear as day, right? We gapped down through it. It acted as resistance, resistance, resistance again. And it's pushing back down from this specific level. And we're still holding the swing low anchored volume weighted average price. So if we crack down through here, or even if we don't, watch to see if price action recoups that 5-day moving average and for it to start turning back up to get more bullish and potentially play it back up to 227.50 and potentially to even up here at around 240 with the prior all-time high. Now, if I look into XLK's top holdings, you got Apple, Microsoft, Nvidia, right? Those are the big dogs in XLK. So we're going to look at those names right now. And if I take a look at Apple, clear as day, we have a resistance here right at about 233. You can see perfect hit of resistance, resistance, resistance. And even here was perfect resistance. So it's not going to be really great until we see price action get through this level. We have a low, we have a higher low, and price action right now is just consolidating sideways. Saw some weakness today. Okay, it is what it is. Look into the smaller time frames. Wait to see the 5-day moving average recover, right? Start to flatten out and turn back up, and for price to prove itself before getting bullish, and then you put a stop under the swing low, whether it be on the 15-minute, 30-minute time frame, or even the daily time frame if you're trying to see a bigger move. So there's Apple. We can wait. It doesn't look bearish right here. If it starts breaking down, right, from this contraction pattern, then it could potentially be more bearish, okay? Microsoft has been consolidating this recent run-up, and we've recently just we actually broke this anchor volume weighted average price today, closed, and then we came down into and around the inclining 200-day moving average and the swing low over here on Microsoft's anchor volume weighted average price. So if we can hold these levels, right, what would that be? It'd be a low, a higher low. It'd be a higher low. We would have a high, a lower high, okay? So we'd want to see on the smaller time frames this recoup the 5-day moving average and start to turn back up from that point and then go from there. And this right here, right, could be technically this would be a higher high there. If you're taking this high and this high, then that would be a lower high. But if we're considering this, because that was a nice bounce, I would say that would be a higher high there. Okay, continue on. Nvidia, that's the other one that was on the list there for XLK. Where did we come into today? Well, we saw some sell side activity as an outside day, some bigger volume, but we still have a low. We still have a higher low. If I anchor this volume weighted average price of this swing low, what do we see? Wow, it's right in confluence to this breakout area that we broke out of this tight consolidation. Boom, and we're back testing it right now. So for me, for instance, I want to see, like, even if it undercuts and freaks people out and shoots some people, like shakes them out, look for the 5-day moving average to start turning up. Look for price to recover to potentially go back up and try to break this 125, which is clearly a level of resistance, support, bam, back to resistance, bam, we cracked under it, saw some sell side, and boom, we tried to get above it, we couldn't close above it, and we saw some continued sell side there. So this 125 level seems to be a little thorn there for the price of Nvidia. Now, we do have some other big cap names that have been performing very well. So if we take a look at something like Meta did have this cup with handle. We broke out, and we have yet to backtest. So if Meta starts to see weakness, start to look for a backtest potentially at around this 540, 541, and this prior swing low anchored volume weighted average price. And then Tesla too. Tesla broke out of this contraction pattern over here. We back tested it. I anchored a volume weighted average price. And then also price action tightened up here too as well, right at about that 233. And we saw some continuation into a prior area of supply. So if this starts to back off, starts to consolidate, we can see what happens there. And then we want to see this pick up a little bit. And if this can hold, maybe it sets back up for another shot there too as well. So those are the bigger market cap names. Let's go ahead and look at the Sailor to Shift tool, which I haven't talked about for a minute because price action has been rather just choppy overall. Now, we did get a buy signal. We did not get a buy trigger. Now, the buy signal came because the rate of change between Bitcoin and gold started flipping positive, okay, getting through this zero line over here. Now, we had a weekly close, and I'll zoom in here momentarily, but we did not get cross above that. So we are seeing some weakness in the price of Bitcoin these last few trading sessions, boom, boom, right? We saw some sell side. That's totally fine. Where would we technically be the buy trigger? The buy trigger would be at this swing high right here, right at about 66,000. However, if we don't cross through that this week, right? If we don't break through that this week, what happens? Well, if we stay in a buy signal area, then we go down to the following week's high, which would be just 65,500-ish range, and we'd have to break that. And if we don't cross through that week and we're still in a buy signal, well, we would go to the next high of the prior week that we have to look at. But if we cross down through it and we close down there on a week and we never get the buy trigger, well, guess what? There's a no trigger policy for that, okay? Now, if I take a look at Bitcoin, we are just chopping around. We've been consolidating, but I want to call out that the 200-day moving average is starting to actually curl around. And yeah, price is breaking from it a little bit here, and you can see it's kind of actually acted as resistance in these areas, and we've tried to recoup it. But the longer we trade down here, that's not a good sign, because it's harder to change the trend when the larger term trend starts turning down. So you want to see, if you're bullish crypto, you really want to see this start to recoup and this to start flattening back out and turning right back up again. So that's what I'd be looking for in the price of crypto. That's all I got for you on today's episode, everybody. Hope it helps out. I'll see you on the next show.